Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Masser and Tim Stennebeck on Bloomberg Radio.
The fight for Warner Brothers Discovery, guess what? It's not over yet. Not by a long shot. Both Netflix and Paramount Skydance are now strengthening their financial backing for their respective offers. So where do things stand right now? Let's get a check-in with Bloomberg News media editor Molly Schutz and Bloomberg Intelligence senior credit analyst Stephen Flynn. They join us here in studio. Thanks so much for being with us. So Molly, I'm just going to start with you. Just bring us up to speed on what Larry Ellison is saying here. I guess he's throwing his own personal fortune behind this deal to say, hey, listen, we're good for the money.
That's right. He's putting his name on the line. He's saying, I'm personally backing this $40 billion in equity financing to help his son, David Ellison, who's the CEO of Paramount Skydance, succeed in their takeover offer for Warner Brothers.
But okay, so I want to bring in Stephen here. Larry Ellison is the fifth richest person in the world with a fortune of around $246 billion. Are there any credit risk implications of his personal guarantee, or does having a billionaire really backstop meaningfully and extend the runway for deals like these?
Yeah, sure. So it's important. You have the backstopping of Larry Ellison. You also have a lot of other funds involved. And importantly, they also have a $54 billion secured credit agreement in place. So there's plenty of financing to support the $30 per share cash offer for the tender offer for Warner Brothers shares.
So Netflix, though, was talking about a bridge loan, right, of nearly $60 billion. How, if you had to stack it up, because I'm sure the board, right, at Warner Brothers is going through this whole, pros and cons list. How do these two, Molly, I'll ask you first. I'd like both your thoughts on this, but how do these two deals stack up next to each other when you're talking about, I'm just talking about the financing of the debt. Is there one that just seems more plausible or more attractive than the other?
I think the latest offer by Paramount today shows that was their effort to say, look, we've got the solid footing here. This will help with, credit, investment grade, help our investment grade, and show that we're serious and that this bid is solid, which Netflix already has an investment grade rating and was seen originally as having a better, solid financial footing.
What are your thoughts?
So listen, Netflix is a much, much stronger credit than Paramount Skydance. Netflix has a single A rated balance sheet. They have a large market cap. They have growing EBITDA, growing free cash flow, and very, very low net leverage. So Netflix has plenty of capacity to borrow in the investment grade corporate bond market. Now the company has single A credit ratings. I believe Moody's has already affirmed their single A rating. I expect S&P to do the same. So they have plenty of capacity. On the flip side, Paramount Skydance, they have a bridge commitment in place. So the commitment is there from a number of large banks. Now that is secured debt, and that they will probably strive for investment grade ratings on that secured debt, saying, hey, this comes ahead of the other debt that the company has. And if you use Charter as a comparison, you could have a split-rated capital structure where you have secured debt that's rated investment grade and certain other debt, whether it's unsecured or security that's inferior to the security provided to the other debt with high-yield ratings.
So you can get creative with the way you sort of stack the debt, if you will.
Yeah, plenty of companies get very creative.
I bet.
So that structure aside, talk to us about a media tech standpoint. What will it look like if the company merges with Netflix or with Paramount? Which makes more sense?
Well, both Netflix and Paramount think their deal makes more sense. For Netflix, obviously, it gives them direct access to the library, one of Hollywood's most iconic libraries for film and TV content with Warner Brothers. And that's also what Paramount technically is trying to do. Paramount Plus is a much smaller streaming service right now than Netflix. So they're really seeing this deal as a way to bulk them up and allow them to compete better with the likes of Netflix and Amazon and Disney.
Is this Larry Ellison offer now a last-ditch effort, do you think, by Paramount Skydance? Because we know that Warner Brothers is already saying, listen, to the shareholders, we want you, we believe the Netflix is a stronger deal, we want you to vote that way. do you think we're going to hear yet again from Paramount? And what might that be? Might it be a sweetened offer if this doesn't work?
Yeah, well, so mid last week, the Warner Brothers Discovery Board recommended shareholders do not participate in the tender offer, and they listed reasons why. Now, what Paramount this morning has done is kind of address many of those reasons, particularly given the Larry Ellison guarantee. So I believe Paramount's going to see how many shares they get to participate in the tender offer, and if they need to, conversations with shareholders, if they need to raise it to a certain level that they're still comfortable with, I'd imagine that's what they would do.
Talk to us about the size of this deal, because our Bloomberg story said something like it's the biggest in a decade.
It's definitely one of the biggest media deals in a long time. I mean, it harkens back to the days of Disney and Fox, those kinds of deals. I mean, this is definitely a big deal, both financially and also in terms of what it means for Hollywood and for content production and the creative industries at large.
Is the debt financing now, you think, the deciding factor here for the board of Warner Brothers? Is this what it's going to come down to for them, do you think, Stephen?
No, because I don't think if you have a commitment in place, that's why companies get bridge loans to say that, hey, we're good on the debt part. Look at the financing here. It's provided by a slew of banks. Mm-hmm. So that typically provides companies with some comfort that the debt component's going to come through. I think what Warner Brothers was asking for more comfort on the equity side, right? Because there's over $40 billion of equity capital as part of their acquisition proposal for the Warner Brothers shares.
How does Ellison's bet change Paramount's position relative to like Netflix, YouTube, and Amazon? Does it enable a different operating model, or is it just really scale at this point?
I think it's mostly scale. Yeah, Paramount's argument is that we will be a good steward of this content, and this will allow us to, because Paramount Skydance is a pretty small operator in terms of, if you're looking at compared with Disney, Netflix, even Amazon, and so really having a studio like Warner Brothers behind them and to be able to tap into that library of content would really be a step up for them.
But I guess a big difference between these two offers is Paramount Skydance wants the whole thing, including CNN, right, TNT, where Netflix doesn't want that. They want the studios and the streaming service. So what if Netflix does win this bidding war? What happens to CNN and those cable properties?
So the way the Netflix deal is set up is that they're going to have Warner Brothers Discovery spin off their global networks business. That includes many of the channels that you described here. And what will be left behind is the studios, which is very valuable, and the streaming business, which is very valuable. And then Netflix will acquire that remaining company. And that's what makes it a little bit tough to compare the valuations here, right? Because Netflix was offering $27.75 per share, mostly cash, but some Netflix stock for the remaining company. So investors had to figure out, okay, what's the per share value in the global linear networks that's being spun off? Paramount Skydance is saying, hey, that's only worth $1. Some people are saying, well, that's worth several dollars. And so that $27.75 plus the value of that stub piece is your total value compared to $30 a share in cash from Paramount Skydance for the whole company.
Which one is the front runner here so far, in your opinion?
Well, clearly from the board of Warner Brothers, Netflix is, right? They accepted Netflix offer. They put out a letter last week saying that why investors should reject the Paramount Skydance offer. So it's hard to break a deal. It can happen, but it's hard. So it seems that Netflix, given what's going on so far, is ahead. But some tells you that this is going to last quite some time, right? Paramount Skydance has significant financial backers. They really want this. You could argue that they really need this. They need to gain scale. And so they're motivated. So I think we still have a ways to go in this.
So if this thing drags into 2026, which it looks like it very well might, we know the media landscape's continuing to change. Let's just say, Paramount doesn't get Warner Brothers. What does Paramount do? Do they eye another company? And if so, who might that be?
I mean, I think that's the big question now. Where will they go from here? David Ellison has said, I mean, despite the fact that he really, really does want this company, he says, well, okay, if we don't get it, we'll be able to proceed, and we'll still continue to produce great movies and great content, and we'll find other ways to grow and to compete.
Yeah, let's remember, Paramount Skydance was recently formed, right? You merged, you had David Ellison Skydance merged with Paramount, and they took out the national amusements on the Paramount side. So that company was just formed. They had a plan. They were going to cut costs, grow certain areas, and so improve the overall business. And now Warner Brothers would give them a certain amount of scale. If this doesn't work out, I'm sure they could look for other assets for additional scale.
All right, we're going to have to leave it there, but certainly we're going to see how this all plays out as I guess the board continues to look at these deals through the holiday. I think a lot of folks thought that, well, maybe we can wrap this thing up. Netflix might have thought we can wrap this thing up and all celebrate the new year, but there's still lots and lots of question marks. Our thanks to Bloomberg News Media editor Molly Schutz and Bloomberg Intelligence senior credit analyst Stephen Flynn for being here in our studio to help break down what really has become a quite complicated scenario for all of these companies. Lots of tangled webs. So thanks a lot for being with us.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
So, Alexis, it's been really a stellar year for markets in the U.S. and across the globe, and we've talked about how the S&P is on track to see its 8th winning streak, its longest winning streak since 2018. And already next year is looking quite optimistic. We have sell-side strategists really putting their price targets for the S&P out there, and the range is around 7,000 to 8,100.
That's quite the range.
It's quite the range, but it's high. For context, we're around 6,800 to 6,900 at this point. And it's really hard to make sense of the markets next year because we have a lot of optimism, but we do have a lot of uncertainties as well. And joining us to make sense of all of that and to give us a look ahead is Kuang Nguyen. She's the Chief Investment Officer of Equity Strategies at the Research Affiliates. She's with us in the Interactive Broker studio. So thank you so much for joining us on this Monday to help us make sense of all of this. We're seeing a bull market right now, and it's a bull market that's broadening beyond mega cap tech into mid caps and small cap stocks.
Absolutely.
Why does that matter to make this rally durable?
I mean, I think that when you have very, very narrow leadership, the danger is always that there's a hiccup in something and whatever it is that's driving that narrow leadership. And we saw that recently with the whole AI story, people wondering whether or not these stocks are overvalued. But I think one of the things that you're seeing is that a lot of other stocks are benefiting as well. So as long as people have a lot of options to choose from that continue to do well, people will stay invested.
Do you have reason to believe we're going to branch out from the sort of narrow stocks we've been looking at driving the rally this year? And by that I mean, are we going to break out of AI and start to see some opportunity elsewhere?
I think we're already beginning to see that. I mean, if you take a look at what's happened in the markets this year, everybody is focusing on the Mag 7. Right? Everybody's focusing on NVIDIA, on Alphabet. But if you really think about it, NVIDIA was not the top performing chip stock this year. NVIDIA is up something like 36%. And you have Intel. Remember that stock from long ago? That's up 82%. So I think you're already beginning to see broadening out within technology itself, but you're also seeing broadening out to other sectors. Financials are doing well. Healthcare stocks are seeing signs of life now.
So there's massive capital flowing into AI. In the short term, we're seeing who are the winners, but not everyone will be a winner longer term. So how real is the risk of overinvestment in AI? Because already we have investors kind of feeling jittery that it might not be paying back, at least in the short-term horizon.
Sure. I mean, I think that one of the things that we see is that the companies that are investing in AI are really strong cash flowing companies. They're very, very strong. There is some debt behind this, but it's not an overwhelming amount of debt. So I do think that there is the risk of overinvestment. I don't necessarily see a real risk quite yet, but also I think it's really hard to pick who the winner is. So the best way to invest in this is to stay diversified.
We're most likely going to be in an environment of lower interest rates. I mean, it looks like the market is banking on 2 interest rate cuts. As long as we don't get an interest rate hike anytime soon, we might very well see these financials do well, these smaller and mid-cap stocks do well. But is there an area of this market you wish was seeing a little more love that isn't, that maybe, should be, and that people are just overlooking?
So one of the areas that I do think is highly overlooked is really the consumer sector, right? So you see a lot of the large names, consumer discretionary, doing poorly. I mean, Walmart's done well this year, but you see a lot of companies not doing so well. You see Target, for example, a beloved American brand. And again, there the issues are changing consumer taste and whether or not they can keep up.
I love your talking points. The very first one is short term, interest rates are coming down, everything else is commentary. Is that really the story right now, or are investors already looking past beyond the rate cuts?
No, I think that if you take a look at what drives markets just tend to go up. They stay with whatever momentum it is, unless something happens to change that. And what usually happens, what's usually necessary to change that upward trajectory that we're in right now, is a tightening of financial conditions. If you take a look at, bear markets, meaning they go down 20% over a certain period of time, they're always preceded by some sort of tightening financial conditions. And we're not seeing that right now. I do think that lower interest rates are benefiting U.S. equities, but they're also benefiting non-U.S. equities, namely emerging markets as well. So I think investors are going to have a variety of opportunities to choose from next year.
I'm really glad you brought up EM, because emerging markets have sort of been the sleeper story, I think, of the year. They've really done quite well, and even Europe has sort of come along for the ride. So if you're looking for opportunities to diversify outside of U.S. equities, where in particular might you be looking next year?
Oh, I definitely think emerging markets are exciting, particularly China. I mean, China got so cheap. And what you're seeing there is, yes, there are difficulties with growth, but I think you have a lot of world-class companies there. A lot of money was flowing out of it. Now money's flowing back in because of the valuation opportunities. We're also seeing more of a stabilization of the trade situation. All of these things really do help emerging markets a lot.
And I want to go back quickly. You've pointed out that AI is already changing the investing landscape, especially in the startup world. How does AI lower the barrier to entry compared to other tech super cycles?
So I think AI is just the most recent tech super cycle. I mean, if you really think about the tech bubble, the late 90s, if you wanted to throw up an e-commerce company, pets.com, for example, you had to go out and invest a lot in computers, in servers, in bandwidth. It was very, very expensive to have a startup. The cloud came along, and essentially you could just license a lot of this stuff out, right? It became much, much more cost effective or less capital intensive to have a startup. And I think now what you're really seeing is on the software side, you're getting a lot of benefit from AI. What I'm hearing from people is that if you wanted to start up a company like Uber or Lyft, you need a lot of coders, right? To create that entire code base for you. But now with AI, all coders are becoming, or at least the coders that know how to use it, are becoming much more productive. You need to hire far fewer people. That said, it's most beneficial when you have a new code base, right? So if you have an existing code base, it's not nearly as productivity enhancing. And so in some ways, I think one of the things that we're seeing is that I wouldn't be surprised if there was a lot more new ideas being put into play in the venture world, a lot more disruption that happens in technology.
All right, we're going to leave it there. Kuei Nguyen, Chief Investment Officer, Equity Strategies with Research Affiliates. Thanks for coming by and giving us your thoughts on where the market is now and headed into the new year.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
This is the Bloomberg Businessweek Daily podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Things are shaping up to be sort of a festive end, if you will, Isabel, to the year for the markets, and a solid start to the new year. We have the stocks now, U.S. equities, erasing those December losses. The S&P set for its 8th straight month of gains.
It seems like the Santa Claus rally is really shaping up, and Santa Claus rally is, of course, the last trading days of December, the 5 last and the first 2 in January. And we have Mark Hackett of Nationwide saying that the Santa Claus rally is typically the best 2 weeks of any trading year, since 1950. So, as you said, it's great water cooler chat, and I will definitely use it on December 24 when I meet my friends.
Even if trading volume is thin, because we know lots of folks are not participating. Also, just want to throw in there, fund managers are maintaining record low levels of cash right now. So they're really putting money to work in this market. Markets are still banking on 2 rate cuts next year. And we had Fed Governor Stephen Myron on Bloomberg Television earlier today, and he said the central bank actually risks sparking a recession unless it continues lowering rates next year, though we know he has a bias right now to lowering rates in a more aggressive way.
So the bullishness is really there, but inflation remains above the Fed's target. Unemployment has ticked higher, and the heavy AI spending has yet to be realized. So I feel like there's also uncertainty, even if all the bulls here are like, rah, rah, rah. 2026 is going to be great.
There's not a lot of clarity still going into the new year. Precious metals, by the way, have been on a tear this year. Gold and silver on course for their strongest annual performance since 1979. Wow. Gold up more than 65% and silver up better than 100% so far this year, with still a few more trading days left. How much further can they go? Mike McGlone covers commodities for Bloomberg Intelligence. He joins us from the Bloomberg Miami Bureau. So Mike, first of all, I've got to ask, because we have seen all year long stocks rising in tandem with precious metals. This normally doesn't happen. Explain to us why that phenomenon is happening this year, if you can.
That's the harder question. Why? It's a key thing is gold is basically grabbing alpha in a significant way. So it's up almost 70% on the year. S&P 500 is maybe 20%. So it's way outperforming. I think part of it, the main thing was the main trigger was 2022, Russians' invasion of Ukraine and some of the issues with the dollar. But gold just absolutely loves our new president, Mr. Trump. He's pushing back on the Fed. Potentially creating more inflation, running it hot. It's all good, and his volatility is all good for gold. The significance I look for in gold, and I was looking forward, is you mentioned how extended it is, how stretched it is. History does not really bode well for new longs at these levels. One good example is silver. Its peak, its close in 1979 was 32, and this year's low was 28.
So we have Goldman Sachs among the several banks who predict that prices will keep rising in 2026. They're issuing a base case scenario of $4,900 an ounce with risks to the upside. Do you see more runway for growth for gold here, or are we going to see maybe a correction soon, because we have kept on rising higher and higher, up around 60% this year?
There's an old saying in markets, you're supposed to be selling when they're yelling. That's the inklings I got in cryptos last year, and that kicked in this year. And I'm getting those inklings in gold and silver now. Now, I've been bullish forever, but there's never wrong where you can say take profits when it goes parabolic. So momentum could easily carry it to 5,000, but a normal correction from such stretched levels, baby, it's almost 100% above its 60-month moving average. This is the most since 1979. Can easily get gold back to 3,500. That's just how it works and has worked in history. So I look at gold here as just absolutely frightening for what it means. To me, the implications of gold going up at this high velocity and crude oil going down at this high velocity is potentially global deflationary inklings, and potentially it's signaling a down year for the S&P 500 next year.
But I'm looking at sort of everything around the precious metals, like geopolitical tensions, the things that would make people sort of run to the quote unquote safety of these precious metals. I feel like 2026 has a lot of geopolitical tension, Mike, I got to tell you. And I think that maybe that could be a tailwind for these metals, don't you think?
Oh, well, absolutely. You're describing the current bull market, things we talked about 5 years ago, things that were happening. But the bottom line as commodity strategies now is just look at the lessons of history. Once you get to these levels, everybody points out the fundamentals. There's always good reasons. But you have to flip over to your risk management hat and say, do you realistically think the relative value is good for getting overweight long at these levels? And it typically is not. So I'm very concerned. One thing that's never happened in history is we've never had gold rally at this velocity, almost a 100% difference versus 60-month moving average, with stock market volatility staying this low. That's never happened. That to me is I think it's going to indicate next year is that stock market volatility, 120-day volatility at 11%, which will be the lowest since 2017. It's just going to pick up and get to its average next year, which is closer to 20%. Not a big deal, but that might seem a big deal when the market corrects. So that's the signals I'm getting. It's just purely frightening.
We've seen gold-backed ETFs seeing inflows rise week over week in the past, I think 1 month. But you know what has seen outflows? Bitcoin ETFs. And I know you also write about Bitcoin and crypto. Can you talk to us about your outlook briefly for next year? What are we expecting in that asset class?
So I think Bitcoin's more likely to revert back to its enduring mean around $50,000, which has been the case on the annual charts since 2021. I don't think it gets much above 100,000. It has the curse of the best backtest in history and the biggest ETF launch in history. And now we're finding out the realization of what happens with a great backtest. Usually that means the best is over. The thing about Bitcoin, it was one cryptocurrency in 2009, and now there's 28 million. So it's basically the whole cryptocurrency space is a bunch of pigeons versus four doves, which is gold, silver, platinum, palladium, and precious metals. So that to me is what's happening. The bottom line, I think, for cryptos next year is the stock market absolutely has to go up, or that Bloomberg Galaxy Crypto Index, which is down about 20% on the year, which is the same price since 2021, will probably continue to drop next year. I think the whole space is just getting overhyped, got a little bit too bullish, and I'm fearful the precious metals are getting a little bit overhyped and a little too bullish now.
So, Mike, as you look into your crystal ball for 2026, which precious metal has more runway in your opinion?
Well, I think gold's going to continue outperforming virtually all commodities and virtually its own stock market, but this time potentially with the stock market going down rather than going up. So the key thing to remember about gold is always outperforms almost everything except maybe treasury bonds when the stock market's going down. And to me, that's the biggest risk for next year. It's not in anybody's model. It's everybody's assumes the stock market's going to be up 11%, which means it better be, or we got issues. And the ratio between Bitcoin and gold has been a key indicator this year. It's dropped to down about 19 ounces of gold per one Bitcoin. That's the lowest level in almost 2 years. That's a good leading indicator. It's pointing lower. I think that ratio is more likely to go to 10 than anywhere get above 30.
All right, good stuff. Something tells me we're going to be talking to you a lot, Mike McGlone, in the new year. Okay. We always appreciate your insights. Bloomberg Intelligence Senior Commodity Strategist Mike McGlone, they are joining us in sunny, warm Miami, as we are here in cold, chilly New York City.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
I want to switch gears and talk about these Trump accounts, right? They're part of the president's one big, beautiful bill. They're designed to create these investment nest egg for kids. And here's how it would work, Isabel, right? So children born now through 2028, they're going to be given $1,000 from the federal government into an account that would act sort of like a hybrid IRA or 529 plan, because there are some tax consequences here. It would be managed by parents until the child turns 18. And we know they have the backing of some deep-pocketed investors like Ray Dalio. Michael Dell and his wife are donating $6.25 billion to help this fund, to help fund the Trump accounts. And Michael Dell spoke earlier this month with Bloomberg's Caroline Hyde about his donation.
We do think that this will be catalytic and that more philanthropists and companies will join us over time. And again, this is a platform for the future of these children. Long term, we think investing these accounts in the S&P 500 is a very good way to compound over time for these children.
Well, our next guest says Trump accounts, they're not the answer when it comes to closing the wealth gap for the next generation. Derek Hamilton is a Henry Cohen professor of economics and urban policy at the New School. He's also the brainchild behind baby bonds. Connecticut was the first state to implement this concept just a couple of years ago. And since then, we've had more states come on board, including California. I also believe Washington, D.C. And Derek Hamilton joins us here in studio. Derek, thanks so much for being here.
Thank you. Glad to be on the show.
Yeah, especially ahead of the holiday. I guess there's a lot to dig into, but let me just start with what is, I guess, the main difference between baby bonds and the Trump accounts? Because on their face, there seem to be a lot of similarities.
Well, conceptually, the goal is to provide access to asset building by way of having some financial capital so that you can get into asset building. The problem with the Trump accounts versus baby bonds is baby bonds focus on what actually is the problem. It's one of endowment. Essentially, the way wealth is created is wealth begets more wealth. It's having a large enough nest egg so that you can get into a home or get into an education without debt, or to be able to have some capital to start a business. The Trump accounts essentially emphasize savings by way of the tax code. So in an ironic way, it's structured in a way that's potentially going to subsidize those that have the wherewithal to raise capital in the first place.
What does it signal to you when billionaires step in to fund youth wealth building programs? Are we seeing it as innovation that government couldn't achieve on its own, or is it just a quiet shift away from maybe public responsibility? I
mean, I applaud philanthropy that desires to be vanguards in trying to create pathways to democratize wealth. However, the mechanism in this case is only feeding into a bad system. The federal government should not be ultimately subsidized for their duty. We shouldn't be reliant on the charitable contributions of a billionaire for our salvation. But what a billionaire can do is provide demonstration, be a catalyst, seed some momentum so that we ultimately can have them invested. And, I'll make one other quick point, which is when you think about the $6.4 billion, which is a huge number, it requires context. So 2 context points. One is it's contextual to that $4 trillion big, beautiful bill that was referenced at the beginning of the segment. So if we're thinking about the ways in which the federal government is spending wealth towards advancing access to asset building for the population, that $6.4 billion deserves context to that $4 trillion, which is from our public regress. And then the other context, about 80% of children between the ages of 0 and 10 will have some access to this donation, this regress. But if you were to disaggregate that amounts to about $250 per child.
Right.
So essentially, that's not going to be the catalyst. So it's distracting a little bit.
Some countries have done this pretty successfully, right? I believe Germany is among them. They'll give an allowance, a monthly allowance to parents for kids of a certain age. Some countries use it as an incentive to get people to have more children. It's now, these baby bonds have been implemented in, let's say, Connecticut since 2023. I believe they were the first state. How are things going? Oh, it's still in the infancy there, but how are things going?
I mean, Connecticut is a really great model, and it's a state, so it doesn't have the capacities of the federal government. But here you have a scenario where every Medicaid birth will receive $3,200 automatically at birth, and the treasurer is managing that money in a collective fund in an astute way with responsible investing, where the projections are that the children, low-income children born as part of a Medicaid birth from rural to urban areas throughout the state will have about 12 to 18,000 as some seed capital to begin wealth building. And then, other examples would be the UK did it. They didn't fund it to the extent that we would call for in the US. And then here's perhaps even the best counterfactual. The United States has done similar programs with the GI Bill.
That's right.
Right.
That's right.
We have a history of doing this.
Do you think that programs like these have an influence to affect economic policy long term, or do you think they create risking a system that just really hinges on, to your point, philanthropy of maybe rich individuals or big corporations?
And that's exactly why it should be a government responsibility. And here's the point. This is not charity. This is an investment. So if you believe in the market, if you don't believe in the market, regardless, again, it's pretty simple the way wealth is created. It is that down payment that puts you in an asset that passively appreciates over your life. So if you are authentically somebody who believes in transaction in the market, then you should support people having some seed capital to get into that asset. So again, it's a question of endowment, not savings behavior.
Is there anything about the Trump accounts that you actually like? I mean, I think we can agree that, the concept, the heart's in the right place.
Well, I mean, that's just it. The attention on trying to make sure that we democratize access to wealth, that's a good thing. But the structure, the 529 structure, we have lessons from that where, 529 saving, tax provision savings so that we can provide access to college for our children. The bottom 0.5% of earners essentially don't participate. only about 2.5% of Americans participate. So there are really good ways we can do it. My fear is that we co-opt a good idea. It's a really good idea. We have pathways to really facilitate a good value for our American economy, which is inclusion. We just got to work on the delivery.
To Alexis' point, there's the idea of corporation match welfare embedded here. Are there any upsides to that? What should policymakers be cautious about?
I apologize for laughing, but the phrasing of corporate welfare, again, I take the Dells as being not disingenuous, but really trying to be supportive. I think there's better ways, there's more catalytic ways they could spend that $6.4 billion. But at the end of the day, the American people don't want to be at the whim of billionaires. And then there are other aspects as well that we should be leery about, which is state-private partnerships, for which we have to be concerned about the potential for grift when we're relying on billionaires to provide economic security for the American people.
So if we're thinking, look, a lot of folks are not going to take advantage of a 529 plan. Is that because they don't have the money to do it? Is that because they don't know they exist? Is that because a lot of Americans cannot be left to their own devices to save for themselves? I mean, think about how, some of our programs like Social Security came to be. It's because it was supposed to be some sort of a safety net. So is it a good idea for the government to put aside some money for folks who might not otherwise do it?
I mean, that actually is a great idea, but just how and the mechanisms by which we do it, that's the problem. So it is the case that clearly we have an affordability crisis in this country. So people don't have the wherewithal to save en masse. And that's a big reason why people don't participate in the 529 accounts. Not as if they don't love and adore their children and desire for them to have savings. It's wherewithal. And then the other big point is, for those that have amassed wealth in America, it's not active savings that's driving that. And by active savings, income that we actively save, it's passive savings. It's that down payment. It is critical for young adults to really have some capital so that they can get into that automatic vehicle to save.
All right, we're going to have to leave it there, but it's not the last we've heard of baby bonds. We'll see if they come into other states. Are they coming to other states soon? Do we know? Is this in the pipeline?
Lots of momentum at the state level. There are demonstrations. I have to give a quick plug, which is at the Institute on Race, Power, and Political Economy. That's racepowerpolicy.org. We have a whole list of where they are flourishing, the various states, the demonstrations where this idea is incubating across the United States.
Derek Hamilton, University Professor Henry Cohen, Professor of Economics and Urban Policy at the New School. Thanks so much for coming in, especially ahead of the holiday, to talk baby bonds.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.